guest today is Brian Dague. Brian's a certified financial planner for Northwestern Mutual. He's here in my area, actually in Annapolis area, and all around great guy and dad of 5. So God bless you, Brian. Brian's going to, one of the reasons that Sean and I really wanted to vary all the education and do this kind of thing is because we typically don't talk about this kind of stuff. And I think, and I'll just speak for myself, not particularly great at this kind of stuff. Some of us are, some of us aren't. So anything we can learn from this to make our lives better long-term would be great. So Brian's going to go through some stuff and explain some things sort of at a 30,000 foot view. And please make sure if you have questions about something specific, it doesn't have to be necessarily about what Brian's talking about that second, put it in the chat. And I'll get it over to him, or if the group stays small enough, maybe we even unmute and just have you ask the question. But please make sure you're asking questions as Brian rolls through. So Brian, you want to share your screen and take it away, man? Thanks for helping us.
I'll go ahead and put myself up there. Thanks, y'all, for letting me hop on here. Let me get this all fired up. But before I do it, to Mark's point, I'm a father of 5, right? I'm blessed some days I wonder, you know what I mean? I wonder some days, but I've had my practice here with Northwestern Mutual for a decade. I'm 53 years old. Before that, I owned different businesses and really came to this later on in life, in my early 40s. And I really gravitated towards this because I wanted to have my own business. I've been a business owner for years. I love helping people, and I'm a numbers guy. Now at the 30,000 foot, it's like, you could do a lot of things with that. But when I started my practice, we all start our practices from scratch. So whoever's a business owner on, you start with one client, right? And generally that's yourself. But I got 5 great kids, 2 sets of twins in there. I've got a 15-year-old daughter, 2 12-year-old boys, a 10-year-old son and daughter. I live here in Edgewater. Ironically, I live in a golf course community and I do not play golf. Sad, really. Mark, you could tell me later how sad it is, really. But my practice, I specifically work in the area of retirement distribution planning. About 80% of my clients are small business owners, either 1- or 2-man shops, or my largest client's got 150 employees. So really the comments and remarks that I'm going to make today, like Mark said, are very 30,000 foot level. I can go a mile deep on any one of these topics, but for today's conversation, Mark's going to run the chat. I'm not going to roll through this. I'm certainly not going to read you a PowerPoint, because at the end of the day, everybody takes in information differently. If I have one goal for the time, is I hope each of you walk away with one thing you didn't know before you logged in. And in my world, that is a successful impact. And so the mission of my practice is helping people make deliberate choices to improve their financial well-being. So none of what I give today is designed to be advice. It's designed to be educational. Okay. So without jumping in anymore, I'm just going to fire up my screen and kind of walk you through this. Mark, let me know you can see me or see the screen, right?
Not as of yet.
Okay, one sec. Try this one more time. And the big one, where'd it go?
There we go.
Okay.
Yep, we're in PowerPoint.
Okay, can you see that all in one? Can you see one big screen or no? Or is it still little screens? And now you should be good, right?
Got it.
10-4. Awesome. Okay, so a couple things before I just jump in here. The reason I set up my practice with Northwestern Mutual is there's a lot of different financial firms around the country, really around the world. I chose Northwestern because it's funny, Sean, based out of Milwaukee, Wisconsin. They are a 172-year-old financial firm, AAA rated, and they provide me the ability to work in so many different areas, but only have to ever stay within Northwestern Mutual. So they have a plethora of information available to clients and people who just want to learn more stuff. One of the things, and I will send this to Mark and Christine as a follow-up, is again, very basic financial fitness worksheet. So many things in our world, my world of financial planning, they are more complicated than they need to be. You know, the verbiage, everything else, it's just way more complicated than it needs to be. For today's conversation, I'm just going to stay on 5 highlight topics: save, spend, grow, protect, and give. I'm just going to give a little bit on each one. I'll pause if there's a question on anything I'm talking about, but it's really 5 key actions. And the thought process is, if you've done your due diligence in all 5 of these pie wedges you see on the screen, financial security, it's not assured, but it's way more likely to happen. And financial security means something different to everyone that I speak with. My oldest client is 79 years old, okay? My youngest client is the son of a client who's 23 years old, just graduated from medical school. Financial security is a completely different definition for those 2 individuals, but the way we go about our planning looks very similar. So when I talk about savings, right, everybody understands that they need to save. What we do is we coach people to save about 20% of what they're bringing in, okay? For some, that seems like a very high number. For others, it is really only 20%. And the answer to that has everything to do with how you were brought up and what your perception of money is, okay? Personal story, my mom was a bank teller, loan officer at a credit union. My dad ran a printing press. Nobody was knocking on my parents' door to educate them on what financial planning looked like. And by the time that I started my career in doing this, they were well into their early 60s. They had their plan. It was a default plan. I guess I got what I got. So when I'm working with people and I'm encouraging them to save 20%, it's really just math. The other thing that I highlight when I say this is, if you work for an employer who has a 401k and they're willing to match what you put in, even in a small way, okay, that counts towards that 20%. So if you're going to put in, to a 401k and your employer is going to match you 50 cents on the dollar up to 4%, that's 2 of the 20 that someone else is doing on your behalf. That counts. And many times when I have initial appointments with people who have been introduced to my firm, so much of what we're doing is educating people about what they already have with their employer. All right, so we ask for all this information, and a lot of times, shouldn't say often, but there are times when people are like, yeah, there's a match, but I'm not contributing. And my response is, do you have something against free money? And they're like, no. I'm like, well, you must have something against free money, because that is free money. Oh, I didn't look at it that way. Okay, so here's a little bit of education. Look at it that way. So saving is really, and I'm gonna segue into this a little bit differently, but saving is really about 2 things. One, how much you're able to put away compared to how much is coming in. And I have a slide that addresses that. As a certified financial planner, as a CFP, I am a fiduciary, which means the advice, all advice that I provide a client must be in that client's best interest. It's not just a fiduciary around the money we manage if we do so. And one of the very basic tenets of being a certified financial planner is ensuring that your clients have an emergency fund. And when I ask this question, broad stroke, hey, do you have an emergency fund? And if so, what is it? I've been doing this a decade. I get all kinds of answers. The answers range from, yeah, I got a couple thousand in the bank. I have a client that likes to sit on $200,000 of cash at all times. He will not be dissuaded from this because of how he grew up viewing money. Doesn't matter that inflation is bad. Doesn't matter the rational thinking that I provide him. That's what he feels is important. For the vast majority of people, most don't have enough emergency savings to cover a $400 expense without dipping into a credit card. And if any of you have ever been in credit card debt, you know, unless you are diligent about getting out of it, you won't. Because the credit cards love you, specifically when you do not pay your balance at the end of the month. That's a wonderful revenue stream for credit card companies. But the basics are have 6 months of living expenses in an account you can access easily. And my reference point to this over the years has changed. And it changes because I'm not a huge fan of sitting on cash for a long period of time, specifically now that the word inflation has come back in a real big way to start the year. What I would rephrase this as, I want someone to have 6 months of living expenses in liquidity. Liquidity could be a 0% credit card with a balance. Liquidity could be, I have a home equity line on the house that if an emergency hit, I could tap into. It could be another line. It could be a business line of credit for my business owners. And lastly, it could just be cash. The idea is that it's very basic foundation level. An emergency fund provides just that. It's breathing room. Psychologically, it's not, holy crap, if XYZ happened, if something, I got to go dip it. That's not a great way to live. And for the clients that I've coached over the years, getting them to the point where psychologically they know they could weather a storm, being the loss of employment, or maybe an illness, or one of their kids needs something, that has been the most impactful part of their plan. Remember, everybody's different. What's important for you may not be important to the next person. But the 6 months emergency fund is kind of that foundational, have it. If somebody, I want to say, balks at that, like, oh my God, it would take me months and months and months and months, great, get to 3 months. Put something aside. So that's kind of like principle one of savings. Even before I have clients who are like, hey, I want to invest, I want to put money into the market, I want to do this, this, and this. My immediate question is, what is your emergency fund?
Hey, Brian.
Not even what is it, do you have it?
Hey, Brian.
Mark, do you have a question?
Yeah, I just want to ask a quick one on this, because everybody on this call is probably looking at this differently. In your mind, real quick, define living expenses.
Living expenses. What's it take to live every month the way you live? Mortgage, gas, groceries, childcare, healthcare, the whole 9 yards. If you lost your job tomorrow, would you have to put your living expenses on a credit card, or would your living expenses need to be adjusted drastically? For many, there's this is what I live on, this is what I like to live on, this is what I could live on. That, in my opinion, is kind of carving up the baby a little bit. You know what I mean? It's like, only you can decide that, right? There's people who like to really dine out and do everything else. It's like, My role is not to judge how people spend money. My role is really to help people have financial security. So that's really whatever it costs you to live the life minimally you'd want to live. That would be the way I define your emergency fund. Does that help?
Thanks. Yeah, that's great. Thanks.
So the next one is spend, and most of my clients have no trouble spending money. The irony of this is the only clients of mine that have trouble spending money are my retired clients. And it's a mindset. They've been saving for 40 or 50 years and they can't get it. They literally can't get around to spending the money. I have a woman who's my client. She's a widow. Unfortunately, her husband passed. I got introduced to her after that had taken place, and we brought her in as a client, and we looked at her balance sheet. Her number one goal, can I keep the house? That was her number one goal. By the time we were done finding the money, like to the point where there's paper bags of cash in a closet finding money, her balance sheet net worth was about $1.5 million. Every year, every 6 months we talk, every year we get together, we review the plan. The last time she's like, do you think I can afford to go to Myrtle Beach for a 4-day visit? I'm like, well, yeah. Why don't you just buy the condo in Myrtle Beach? She's like, oh, I can never do that. I'm like, yeah, but you can, right? Those are the folks that have trouble spending money. Everybody else has no trouble spending money. The idea is many times we spend more than we bring in, right? It's just the way it is. And this is a question, again, I asked many people, I would be shocked if 10% of you track all of your expenses. Now, I'm open to being shocked, but I'm just saying, of the years I've done this, most people account for the money after it's left the building. Oh, that's where that went. Not I have $300 this month to spend on X. I don't even encourage people to be that methodical on a month-to-month basis because, in my humble opinion, it doesn't allow them to live with their money, and they're always in bean counter mode. And I'm a big fan of actually living or thriving and not just surviving. But I have a template like I do for everything else. Before we engage with a client, I send out a budget template. And I have one prerequisite before I have an initial conversation: fill it out. I don't know if it's perfect or not because I don't walk in their shoes, but there's not one person who has shown up to an initial appointment with myself or a member of my team that didn't have an aha moment looking at their in and out. Either it's like, wow, I have all that money left over. Or it's, wow, I'm spending that much on ... And when you think about money in general and the psychology of money, a dollar can either be saved or spent. There's no third door. So it's either going out or it's going into the bank. But again, kind of the basics. Where's the money going in? What's my capacity to save? This is something that I do personally around this time of year, tax time, everything else. And as a little hint, and I share this with people, all of you have cell phones and electric suppliers and who knows, lawn guys, whatever service provider you spend money with. I would encourage you to take however long it takes, call each of them and say, yeah, can you get me a better rate on that? Can I cut some? I don't need that. Would you? Yeah. And it's more likely, if you don't ask, you're never going to get. My wife jokes with me each year because I got 7 people that I call every year. And I might save $1,000, $1,500 a year just by calling. And I tell that to people. It's like, hey, these are people that you put on autopilot or just dinging your credit card. And if you lose track of it, next thing you know, oh, hey, 15% increase. So really have a good handle on it. Don't get crazy about it, but at least do it once a year. Are we good? Can I keep going, Mark? 10-4?
Yeah, you're good, man.
Here's the other, again, the basics, the 20%. And again, this is a guideline. I have nobody who lives by this rule entirely. Discretionary expenses, it's like beauty's in the eye of the beholder. I have some people, it's like, it might be discretionary for Christine, but it's not discretionary for me, right? So again, this is more psychology of money. Whereas if we know that 20% of what comes in needs to be set aside for later, that's because of two things. One, we're going to get to a point in our lives where we either don't want to work anymore, we don't feel like it, we can't work anymore, or somebody doesn't want us to work, right? Business owners are different in that regard. They kind of masters of their own destiny, but the idea is something must be saved for later. The other reason is we are living a lot longer than we used to. And like, for instance, when I'm running a retirement plan for a client, I'm running that plan for at least age 95. And I'll get a lot of, I'll never be around and I won't make it. I mean, I'll hear it all, right? And I say, great, but if you make it, then what? Because I'm not going to be here for you. Hopefully one of my kids has taken over the practice or something, because I have a thought about being an impact in the community long after I'm gone. However, we're going to be around longer, so we need to say. But this is just a nice guideline. It's nice. I say guideline. It'll say rule, but all rules are guidelines in my world. The other thing is grow, right? And this is one where it's the beauty of time and consistency when you're saving money. And this, can you see that graph okay? Is that coming through pretty clear? This is the education part. When I'm meeting with somebody, I have clients that I brought into the practice that are in the early 34 and 35. Frankly, a little younger than the clients that I'm normally working with. However, the whole thing is like the time of money benefits them and their saving strategy much greater than the 55-year-old client that I just onboarded at the end of the year, even though their goals are somewhat similar. And all this really says is nothing, not one thing beats the beauty of compound interest when you are putting money away. Compounding works phenomenal. I'm reading a book called The Psychology of Money, and everybody's heard of Warren Buffett, right? Like Warren Buffett, and gosh, he's the Oracle of Omaha, and Berkshire Hathaway has gotten 22.2% return year over year, forever. I mean, it goes on and on and on and on. The dude's been investing consistently for 70 plus years. That has more to do with his net worth than his great picks. Okay, it really does, because the time that he's allowed to compound. So when you look at this graph, if any of you are in your mid-20s, it'd be great to invest 48 grand to get down the road at retirement and have 200, rather than being in our mid-40s, invest 40 and then having to put all that away to become investor C for basically a quarter of that money. It's because you don't have the time. It's the same $100 a month. It's the same market return, 6%. But at the end of the day, and this is the way I advise clients who are like, I'm going to pay off my debt before I start saving. And I was like, great. And I'll share with them the time value of money. I'll say, why don't you pay off a little bit of the debt and invest some of this? Because I'd rather you start with less and start sooner rather than wait and think that you can play catch up. And that's the fallacy of savings that, again, many people that I meet they've either owned their own businesses for years, like they've done well, they have money, it's being put away. Many of them have just started saving robustly in the past couple of years because of, guess what? They have multiple kids. They've had other things that happen, so they're trying to play catch up. The idea and the education part is, please start early and keep it going, even if it's not as much as you think you need. Start early and keep going. This is also where I talk about, as I told Christine and Mark, this is my little geek time, right? I don't get into products specifically when I'm chatting like this, but I'm assuming that most of you know what an IRA is, individual retirement account, whether you have it through work, in a 401k or what have you. Hopefully you've heard the phrase Roth IRA, okay? IRAs, 401ks have been around for 46 years. Roths have been around for about half that time, 24, 25. The thought around Roths are twofold. One, you pay your tax now instead of kicking the tax can down the road for later. The reason why I may recommend a Roth to a client as compared to their CPA is an obvious tax deduction reason. You don't get to deduct that $6,000 or $7,000 going into your Roth, but you do get to deduct it going into an IRA. The other thought is, would you say that there's a good chance that our taxes are going to be higher 15 years from now or much higher? Because the thought of us paying less taxes down the road doesn't jive with any financial data that we've seen. Because at the end of the day, tax revenue drives debt. And if you read the newspapers or you understand what's happened in the past couple of years, our country's printed $7 trillion of new money. That's going to come with an invoice at some point. So whenever I'm educating, many times employers now, they didn't used to, but check with your employer if you have a 401k, see if there's a Roth option. If there is, you may want to take advantage of that. I let people talk to their accountants about where their deductions lie. I will generally recommend people who have been doing, I'm working with this couple in their 50s. She's a government employee. She's got a lot of money in a tax deferred account, and she's got 7 more years to retirement. And I'm like, and I looked at, we analyzed it, we did all the math. I came back and say, okay, for the next 7 years, you're going to stop putting money in a yet to be taxed bucket. You're going to put it in a tax now. She's like, why would I do that? I'm like, because I told you to. She's like, yeah, I understand you told me to, but why? I'm like, because you have nothing. She has a pension, good for her. Social Security, which by the way gets taxed. IRA, 401k, every piece of income that she has coming to her when she decides not to work is going to have a future tax burden. Everything. So I'm like, does that sound nice to you? Do you want to be on the tax roller coaster when you're no longer making money to pay those taxes? And notice what, like, you're no longer making money. You're through the money making stage. Now you're the money taking stage. So the tax thing becomes very relevant, which is why I'm a big fan of utilizing never again taxed devices in a financial plan, because we don't have to worry about that. Okay. Pause button. Mark, any questions at all? Am I moving too quick, too slow?
No, you're doing great, man.
Awesome.
Maybe just would you mind, because you're talking about the IRAs and stuff, maybe just because obviously I know a little bit about it because we've talked about it, but SEP IRA,
Yep.
if you're,
Yep.
you know, like I'm a business owner, an independent contractor.
Yep. So generally for business owners who are individual business owners, if you have employees that are W-2 wage earners, the SEP is not for you. The SEP is basically self-employed pension. It's the ability for an individual to put away money pre-tax, similar to a 401k. In fact, the SEP IRA and the solo 401k accomplish the same things. There's ERISA rules around the solo 401k, but it comes with a bigger capacity. You can pack more in there, but it also costs more because of administration costs and everything else. Generally, the SEP IRA allows you to put away up to 25% of your, after you've written off your business expenses, you can get up to 25% into a SEP IRA each year. And that's generally a number that is arrived at with you and your CPA. And those conversations generally go, CPA tells you, hey, you can put up to this away. And if you're my client, it's like, I understand what you can put away. What are you going to put away? And then that's invested just like, you know, a 401k. That is a pre-tax bucket. There's no Roth SEP. That is something that doesn't exist. But the SEP is a great way for an individual business owner to get money put away pre-tax, lower their taxable income now. And then that happens after you've written off all your individual business expenses. And that calculation is generally 25%. And those numbers are historically run through your CPA or your accountant. Does that help, Mark?
Yeah, that's great. I think that's just a good clarification for those on the call, maybe who are independents and single, like I am. That's why I brought it up. But you know,
Yeah, no, for sure.
It can be helpful. And Brian, the other thing that kind of makes me chuckle a little bit when I look at this graph you have up there is kind of everybody on this call either does or has given lessons, and it's kind of looks like it's the thing we deal with of trying to make people better. Is like they're afraid of the short-term difficulties to play the long game and get better long term. They always want the shortcut, and it kind of seems like that's the same case here, right?
It is. I mean, you know, put it this way. Hope is not a strategy, right? It's just not. And, you know, I can hope that I'm going to win the lottery, but I don't even play. You know what I mean? So, you know, the odds are astronomically long anyway. But it really comes down, and to use your phrase, Mark, it's the basics. It's the blocking and tackling. We can sit here and talk about investment theory and everything else. Again, I could go on, and I won't. But if you start with the basics, you can get to the point where it's like, okay, we graduated from 101. What's next? What's next? And that's a lot of what we do with our clients. To get expert guidance, I'm a big fan of what I do because I look at myself as a financial coach. I have clients that I've had for years. I had one right before the holidays called me. She's like, should I buy the BMW or the Subaru? I'm like, I have no skin in that. Like, who cares? But that's my gut. But I got her on the phone. I said, well, what do you like? You know, what's it? And I said, well, you know, sounds to me like the Subaru. She goes, yeah, that's what I'm going to do. I'm like, awesome. I helped you buy a car. Now, I'm not that ingrained with every client, but at the end of the day, there's everybody. You could Google financial guide. You can Google it all day long. There's robo advisors. There's no shortage of advice. The idea is find somebody you know, find somebody you trust. Doesn't have to be a financial advisor. It has to be somebody in the know who can say, who knows you and says, you know what, with everything you told me, this and this and this makes sense. What do you think? I have clients, frankly, I have engineer clients. I'm not dissing the engineer clients, but they want to know how the sausage is made. It's not give me the sausage. It's like, how's it done? Cool thing is, I could tell them how the sausage is made, but everything is done in the context of a plan, right? We don't sling advice, as odd as that sounds. The other thing is, as I segue into protect, everything I've talked about up to this point has been what I would call the offense plan. Offense. Money in the bank, money put away, all those things are offense. The other side of a well-designed, well-constructed plan is the defense. And this many times is the area of planning that goes unspoken about. And I'll share one story with you. As I said, I started my practice late. I was 42 years old, business owner. I was expecting our second set of twins when I decided to start my practice. The individual who I was working with, I'd been working with for 13 years. He's a personal friend. I had been with him at Legg Mason, Smith Barney, Ameriprise, kind of went where he went. Every year he'd come to the house or we'd grab lunch and I'd look at graphs that largely meant nothing to me and would ask him, it's like, how we doing? How we doing? Oh, you're doing good, market's up. It's like, great. I really thought that was what financial planning was. I really did, because I never knew any better. When I decided to start my practice, I got a call from this individual who, hey, I heard through the grapevine, you're going to work with Northwestern Mutual. What are you going to be doing? And I said, well, I'm going to be a comprehensive financial plan. And he's like, I guess you're going to fire me. And I said, yeah, you bet I am. Just not right now. And he's like, I said, but I got one question for you. And he's like, what's that? I said, in all the years that we've worked with one another, sold businesses, had kids, you never once asked me about my disability, my life insurance, or my will. Why is that? And without hesitation, he said, it's just not my thing. So when I started my practice, I made it my thing. And it's not that we do all defensive planning, we just play both sides of the field. So when I segue and start talking to people about protecting things, I'm protecting things that are important. I'm protecting family, I'm protecting businesses, I'm protecting revenue. And the revenue is probably the biggest hole that I find in the majority of the financial plans that my team and I review and the ones that we build. And it's really because no one ever thinks they're going to get sick or hurt and not be able to work. Everybody knows they're going to get to a point in their life when they don't want to work. Wanting to work and not being able to work are two very different things. So one of those other tenets of a well-constructed financial plan is protecting your ability to earn an income. And that is generally done a couple of different ways. Again, if you have an employer plan, whenever I engage with a client, one of the very first things I ask them is, if you have benefits with your employer, request a certificate of coverage from HR. And most of the time, and I know this because I've done it, most of the time that HR director says, what? You want to see what? It's a certificate of coverage. It's basically what happens if I get sick or hurt and can't work. If you don't have group, depending on what you do and how you spend your time, are you swinging a club or are you sitting in an office, there's options to design plans to protect a portion of that income, heaven forbid something bad happens. And again, we look at it from more or less here's the educated side. And I ask questions like, hey, if you got sick or hurt, would you want the same amount of income coming? Very few people are going to say, no, I don't want the same amount of income. So we just help people figure that stuff out, right? And that goes, if you look at what your biggest financial asset is, business owners have a business. That's a big asset. Homeowners, big asset. It's not nearly as big as your ability to go out and make money for the next 15, 20, 25 years. It just doesn't compare. So that ability to go out and make money is big. We help people figure that out, monetize it, and protect it. Most employer plans are only going to give you a percentage of what you're making. no employer plans are going to backstop 100% of your earnings. They're just not designed to do that. The other thing is, if an employer is providing you this benefit and you file a claim, the money coming in to you is going to be taxed just like your wages are. So take 100% of your income, cut it down to 60, and then put Uncle Sam in your pocket. What is left over? Could you still pay all the bills and do everything with that amount of money? And if the answer is yes, then you're good. If the answer is no, then that's where you'd want to look into things where it's like, okay, how can I make sure that I at least have this? Because statistically, and I don't get into statistics on here, when you talk about insurance, insurance is protecting against the tragedy of a loss. You're 4 times more likely to get sick or hurt while working than you are to die prematurely. That's 4x more often. I've got right now about, I want to say 7 clients out on some sort of disability claim. And no, none of them saw it coming, right? So again, tenets of financial planning: protect your paycheck, protect your ability to make money. And then the other one is protect the loved ones or the business or people you care about. And when we do life insurance planning, whether it be for business owners, I do a lot of partnership agreements. It's called buy-sell planning. I pass away. My partner does not want to be in business with my wife. Okay, so I'm going to have liquidity so he doesn't have to do that. It's all about keeping a personal tragedy from turning into a financial disaster. And the thing that gets me is when being in our community, on social media, and I'm not on there a lot, but I'm on there enough. The thing that I want to say gets at me so much is when you see, unfortunately, a tragedy strikes and immediately a GoFundMe page is put up to support his or her family or his or her children, et cetera, et cetera. And when you look at, term life insurance for a healthy individual is pennies on the dollar. That could have been avoided with a courageous conversation. So the 2 defensive mechanisms on here are protect your income, protect your loved ones, or protect your business, provide liquidity. I do a lot of strategic insurance planning with clients. And that's a story for another day. But at its very basic level, life insurance is protecting someone else if you're not here to protect them. Questions at all? Hitting the pause button again.
Nothing right now, Brian. We're about roughly 10 minutes out. So
gotcha.
Doing
the
good.
Last one here, and it's interesting. I mentioned some of my older clients. This is the giving slice of the pie. Like, where would you like to make a difference? When I'm doing my retirement planning, I work a lot with families with kids and multi-general planning. They want to make sure that their kids, their grandkids are getting wealth kicked down to them with as little encumbrances from tax as possible. So earlier on, I mentioned I'm not a CPA. CPA is an acronym that is not behind my name, and that is on purpose. I don't want to be a CPA. But I'm very keenly aware that clients only get to give and spend what's left after taxes. So when we're incorporating that into a plan, it's all right, are you a tither? Is that part of your plan? Is there a cause? I have an older client, her beneficiary on all her retirement accounts and her life insurance and everything else is the Anne Arundel County SPCA. She's never had kids. She doesn't, but every part of her plan is for dogs and cats. And it's not an inconsequential amount of money, but it's important to her. And when I say that, I also use this time to say, make sure that you have a basic estate plan. When I say estate plan, it could be everything from a basic simple will to durable powers of attorney and advanced medical directives. Because at the end of the day, the wealth that you will grow and the wealth that you have grown, you don't want a negative circumstance to throw that into a position where if you're residents of Maryland, I'm only speaking to the Maryland residents, but I also do a lot of work in Virginia, Delaware, and Pennsylvania. You don't want to die without a will. Intestate is not the ideal way to pass. But many times when we're talking about giving, it's like, hey, how are my assets going to be divvied up later on? And are the people and the causes that I care about going to be addressed and addressed the way I want? So as a summary, again, those 5 quadrants, spending the most time on, the save, spend, grow, protect, give. I do a lot of my giving planning with my clients that have already not run their race completely, but they're on the backside of it. They're not growing their businesses. They're getting ready to transfer them. They're getting to the point to segue from one to the other. This just becomes a bigger part of their plan. But ideally, when you're addressing all these, and again, 30,000 foot view, but when you're addressing all these, that donut hole in the middle of financial security, that tends to become clearer. And it also helps you define what that truly means for you and your business, you and your family. So with that, I'm open to questions. That so endeth the lesson.
Hey, Brian, we talked earlier, if we had just a few minutes before we're done, maybe just because you had it in the slide there about understanding the types of life insurance, maybe hitting us up before we're done, just to sort of give everybody a little bit of a picture there of that.
Yeah, let me share a screen. Okay, can you see a whiteboard up there?
Yeah.
Okay, so I crushed my finger splitting wood, so my index finger on my right hand might not work as well, but I'm going to do my best. You see toilet paper at the top of the screen, TP?
Mm-hmm.
Okay. T is for term. Permanent is the P. Permanent. Now there's multiple types of permanent insurance, but the 2 basic types of life insurance are term, which is like rent, and permanent, which is like owning it. And term has a lot of benefits. You can get a lot for a little. A lot for minimum, meaning because in not just Northwestern, but the insurance industry pegs about 2.3% of all term policies purchased will ever pay a benefit. So what that means is 97.7% of the time, all the money any insured would pay into term insurance, they will never get back in the form of a death benefit. It's kind of a win-win. You don't die, the insurance company keeps the money. Okay. I said I work with a lot of families. There's a big death benefit trying to insure all the house, the kids, and everything. Term is a great financial tool. It is generally much less expensive. And again, by design, you're renting it. And the rent is going to expire at some point in the future. Okay. Permanent, which is the ownership, is more or less you're going to pay more for more. What that means is, unlike term insurance, permanent insurance does not have an expiration date. It'll never go away. Even if you decide to stop paying premiums along the way, there will always be a tax-free death benefit to whomever is named as the beneficiary. And permanent policies accrue cash value, meaning they actually grow money inside of them that can be accessed tax preferred later on. So generally, we look at permanent insurance as it's always insurance, right? It's not an investment, it's not this, that, or the other, but it has certain other functions in a financial plan that make it attractive and that make it something to consider when you're building out a financial plan of, do I want to rent everything or do I want to own some of it? Few people, at least the clients that I'm working with, can out of the gate afford to own all of their life insurance, okay? If you have $2 million of term insurance as a healthy 40-year-old, it's probably gonna cost you like $80 a month. You have $2 million of permanent insurance as a healthy 40-year-old, it's probably gonna cost you like $16,000 a year. It's an apple and an orange. But the orange of permanent insurance, that money is going to come back eventually. So when I do strategic insurance planning for clients, I do a lot of education on that, because generally in the world that we live in, people fall into two camps. They're either a huge fan of permanent insurance or they've heard nothing but bad about it. But that's, and again, at a 30,000 foot level, that's the inherent differences between term and permanent insurance. Does that help, Mark?
Yeah, that's perfect, Brian. I think just and that I always consider that one of your strengths, but being able to sort of simplify it and dumb it down for the rest of us, right? So I think that's a great way to look at it, for sure.
No, that's exactly that's. And again, 30,000 foot, there's a million different ways to design them, but that's exactly the main differences.
Brian, just real quick, we've got people on the call, some who may be somewhat closest to you and others not, but easiest way to maybe get a hold of you if they want to get a hold of you.
Christine, if you can send out to the group the contact information that is in my signature. I'll give everyone my cell phone right now, so you have it. But all my contact information, have my email on it. It's 410-980-8229. That's that, and this never leaves my side. And if you call and you've got a question, or if you want to set up time to get together, I'm happy to do that, or even say, hey, you talked about X, Y, and Z. Tell me more about that. I'm more than happy to help you figure some stuff out. Okay.
Awesome. Well, we really appreciate it, man. Before everyone leaves, just as a reminder for those who are on the call, next week is the super meeting coming up fast. So we hope to see all of you there for all of the events, Hall of Fame dinner, teaching summit, the meeting on Monday, the whole shebang. So we still have time to sign up, so please do so. Otherwise, Brian, we really appreciate you coming on, man.
Sure. Happy to do it.
Always appreciate it. And hopefully, I think we all picked up one or two nuggets as you instructed to get better today. So we appreciate it, man. Thanks so much.
Thanks for that. Thanks for the chance to chat with you guys. Have a great afternoon.
Thanks, Brian.